And hello, everybody. Welcome out to our Wednesday YouTube special. How's everybody doing tonight? If you guys can hear me loud and clear, we're going to do a quick sound check. Make sure you guys can hear me okay, and we're going to get started. I see the usual suspects as usual. Dennis, Patricia, Ahmad. Good to see you guys, Team Tackle. Give me a hashtag Team Tackle if you are Team Tackle. David, haven't seen your name in a while. How are you? All right, I'm gonna arrange my screens here so I can make sure I keep tabs on the chat as it's going, and then we're gonna get going here in just a few seconds. Let me make sure I have all my things here up and running, and we are good to go. Team Tackle, that's right. If you have not invited a friend to come out and join us tonight, make sure that you do. Share that link and get people in here. This is a free webinar that we put out every Wednesday night for our tackle members who are, regular tackle members, but for anybody else who might be, brand new and looking for a place that they want to be able to come in and talk trades and get new ideas and new concepts about trading. So be sure that you are sharing and sending out those invites to your friends and family that are out there. All right, so let's get started here. So tonight I want to talk about a little bit more advanced concept or an advanced strategy that I personally use quite often. It's called the Iron Condor. But before we get into all of that and talk about the Iron Condor, I kind of like want to paint that picture as to who might be the person that would want to trade an Iron Condor, or where that might fit into your own personal trading journey or trading playbook. So I'm assuming that, if you've been trading for a while, or perhaps you're brand new, you're looking to get started, the first thing that you need to have is to be able to know what you're going to trade in your playbook. So first things first is we need to have a playbook. Okay. And in that playbook, you're obviously going to have some bearish trades, some bullish trades, and all those and neutral strategies, right? So you want to be able to make sure that you have all of those concepts in place. So if you were thinking about a playbook for yourself, like for you guys who are regular traders and you guys are Team Tackle, when we talk about a playbook, we have typically, and without getting into all the other advanced strategies, we typically use two main Greeks. We use delta and we use theta, correct? So if those are the two main Greeks that we're going to use in terms of when it comes to building a playbook, then we need to categorize and place those different strategies based on whatever direction or bias that we have in the market. So for example, if we're going to trade delta, that means we are trading directionally, which means we're picking a direction, whether it's a bullish posture, meaning that you want the stock price to go up, or if it's a bearish one, if you choose delta as your strategy, then you're going to use delta strategies. If you use theta, then we're going to be looking at time decay, which means that we don't necessarily care that the stock price moves a lot. We are actually going to benefit from the time passing. So those are going to be the two main things that a lot of people are going to have, especially when you're brand new. When you start trading options, especially, those are the two main Greeks that you're going to be using in your portfolio in terms of trading. So we have delta. So everybody in the chat, type in delta. And delta stands for directional strategies. And then we're going to have our theta, which is going to be our time decay. And I know there's a little bit of a lag in the chat, so once you get it, just go ahead and type it. So once again, delta is directional, and theta is going to be your time decay. And if I was to actually draw out a playbook, this is what my playbook would kind of sort of look like. Let's see here if I can screen share and get you guys going here. And let's draw this out. So let's hypothetically say that we are creating a playbook, okay? And here's our playbook. Let me get my pen here. So here's our playbook. And we've decided that we're going to obviously have some delta plays. And we're also going to have some theta plays, strategies, okay? And we said that delta is directional, which means that whether you're bullish or bearish in the market, the stock price has to move either up or has to move down, right? And you profit from the stock price either going up or down. Theta plays are time decay. Okay, which means that we don't necessarily care that the stock price moves up or down a lot. We just profit from time passing. I'm going to try to draw a little hourglass here. Hopefully my drawing is good. I'm not the best, but hopefully you get that. So we profit from time decay. Whereas with a directional trader, they profit from the stock price going up. This is how they profit. We, as time decay, or if you're using theta, you're going to profit from just time passing, right? This is going to be your profit from time passing. All right, so if that's what's going to be in our playbook, now we also have to have our directional bias, meaning are we going to be bullish, are we going to be bearish, and also neutral, because markets don't always go up. We don't always have a bullish market, right? Sometimes we have a bearish market. And sometimes we have a neutral or sideways market, right? So for your bullish trades or strategies, right? Who can name a few of your bullish strategies in the delta category? So if you are a bullish trader and you primarily trade delta, who can tell me what strategy you can use if you are playing bullish and you are going to use a delta strategy? If you know one, go ahead and type it in the chat. But one of the ones that we use primarily when we're dealing with options, we can always buy stock, but we're talking about options today. So we can always go long call, right? If we're bullish and we're going delta, can always go long call, right? And you guys, we had a webinar not that long ago about trading long calls. So if you have not caught that, go back and catch the replay of that, right? And what else could we do if we are trading bullish and we're doing a delta strategy? We can also do a vertical and do a bull call spread, right? And we're just going to keep it to those two for now because I don't want to get into all the different ones that we can, but let's just keep it simple and just stick with those two for now, okay? And that's for delta. So same question. If we're playing delta and we're going bearish, what delta strategies could we use? We could go long put. We could also go we could also do a bear put spread. Right? Now, if we're doing the same for the neutral, if the market is neutral and we want to somewhat play a delta strategy for markets that are neutral, one of the ones that are our favorites, right, is the poor boys covered call. If I could spell poor boys covered call, otherwise known as the diagonal call calendar, right? And you could do the same thing for, you could also do it on the put side. You can do the diagonal put calendar. So we could do that. Now, when we switch this up and go theta, let's switch colors here. Let's go green. So now if we're doing theta plays, same thing. For a bullish posture, what could we do with theta plays? Well, easy one I can think of is naked puts, right? It's okay, Linda. Good to have you here. We just got started. You are fine. Welcome out. We could also do a bull put, right? And again, based on your posture. And by the way, let me go back a little bit and just talk about how we determine our posture when it comes to the market, right? Here at Tackle, we like to use what we call our, if 0 was neutral, right? We would go +1, +2, +3. That's your bullish posture, right? And then if we are going on the opposite side, we would go -1, -2, and -3, right? -3 would be our bearish posture. So this would be our bearish posture, and this would be our bullish posture. And then right in the middle would be our neutral posture. Let's change colors and give it a little orange. Does green and red make orange? I'm trying to like still remember all my different colors. So if I go neutral, I think green and red make orange-ish, something close to that. We'll call that our neutral, right? So anywhere between a -1 to a +1, we'll call that neutral. You guys see that? Does that make sense? Awesome. So going back down here to our theta strategies. For our bearish theta strategies, what could we do here? Well, we don't do that here. We don't typically trade naked calls, but that is something that you could do here if you are bearish. You could trade naked calls, but we don't typically do naked calls at Team Tackle. You could also do a bear call spread, right? When it comes here to our neutral strategies, we could do something maybe like butterflies, but we're here to talk iron condors, and this is what we're going to look at today. So when the market is neutral and you're not getting that directional move to the upside or to the downside, and it's just kind of stuck in a range, there are some strategies that you can deploy that you can also take advantage of when the market is just going sideways, okay? And one of those strategies is called the iron condor, okay? Now, how many of you here are Team Tackle and you guys trade iron condors? And if you're brand new, tonight's your first night, you just happen to, stumble upon this webinar tonight and you're like, what in the world are these people talking about? I must have gone to like a different planet. What is an iron condor? What are they talking about? Say that this is me. I just kind of want to get an idea of who I have in the webinar tonight so I can explain what the iron condors are. So in order for you to understand what iron condors are, you need to have a basic idea of what options are, right? So I'm not going to get into details about calls and puts and all those things, but you do need to have basic knowledge of just options and the Greeks, delta, theta, vega, gamma, all those things. So you need to have a little bit of some knowledge about that, but we're going to talk about iron condors tonight because it is one of my favorite strategies. So if you are brand new and none of this makes sense tonight, trust me, at some point it will. So just hang in there, be patient, and I will try my best to try to explain this, as best as I can. But it might go a little bit over your head if this is the first time you're ever hearing of what an iron condor is, okay? But we're gonna get through it, okay? All right, so we've got some newbies. Never placed an iron condor before, Linda? Okay. Just learning how to trade them. Never done one before. You never done one live, but paper trading. Okay, so we've got a little bit of a mixed bag. All right, so let's open up a new drawing here. Let's insert something new. Let's get another one here going. Actually, yeah, let's do one. Du, 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 du. Okay, so let's get a new one here going. And let's clean this up and start afresh. All right, so ion condors, let's talk about that for a second. So if you know about options, and I'm hoping that everybody here at least has some basic knowledge about options, there's really two types of options, right? We all basically know that. We have calls and we have puts, okay? And there's really only two ways to trade calls and puts. You can either buy a call, or you can, let's change colors here, or you can sell a call. On the other side of the put side, you can also buy a put, or you can sell a put. Okay, so you can do these individually. When we start to getting into the different types of strategies and the different names, like, you know, bear calls and bull puts and, you know, horizontal calendar put spreads and this and that and the other, it's a combination of one or two or three or the other. Okay, so what an iron condor is, it's a combination of all these four put together. But it starts with this right here. This is the, if you were, this is like the primary key ingredient. When we trade ion condors, right? The ion condor is a theory that, if we're looking at the market, that I don't think the market's going to go. Let's say we're looking at a price of, oh, I don't know. Let me trigger Matt. Goldman Sachs. Okay. And Goldman Sachs is sitting at a price range where it's just been doing this for a while. Okay. When you sell an ion condor, what you're primarily telling the market is that, hey, Tyler likes to call him Mr. Market, I don't think the market will drop. I don't think the stock price is going to fall that far. And I also don't think the market's going to go up this high. Okay. And so all we want to do, and again, when we're selling, remember theta is time decay. So all we want to do is for time to pass by. And Goldman Sachs can go up and down and sideways and do whatever it wants to do, as long as it does not what? As long as it does not go above this price or come below this price. Okay. So the premise of an ion condor is that we're really selling insurance to the market, starting with selling the naked put. And if you guys know what a naked put is, when you sell a naked put, right, you are telling what? You are obligated to buy the stock if the stock price comes down to whatever strike price you sold. That's what happens when you sell a naked put. So you're pretty much the insurance seller. So when you think about how insurance companies work, I'm going to use an analogy here because I have a friend named Jake, and State Farm has been, it's been on TV for a lot. I'm seeing a lot of Jake from State Farm commercials, I guess, because NFL is, or either State Farm is a sponsor of the NFL. That's how it goes, right? So State Farm is a sponsor of the NFL. So we've been seeing a lot of those State Farm commercials with Jake from State Farm. So Jake sells insurance, okay? And I have a friend named Jake, so I'm going to use my friend Jake as the example. So let's say my friend Jake sells insurance, okay? and I have a car that I need to insure for the next 6 months. Okay. Jake is going to sell me an insurance policy right now based on my age and how good of a driver I am and my driving record and all that stuff. I'm going to have to pay a monthly premium. I'm going to pay a monthly premium. I'm buying the insurance, so I'm going to have to pay Jake a monthly premium for me to have coverage on my car in case I wreck my car or if I get into a car accident. Jake is going to sell me the insurance. So Jake's going to get paid for selling me the insurance, right? Now, Jake, although he's my friend, is hoping and praying that within that 6 months of me having this insurance policy that I do not wreck my car, because if I do wreck my car, then he has to do what? He has to pay me to cover for the wreck or the accident or whatever, either replace the car or fix the car, right? So when we sell insurance to the market, we're selling insurance to the market, but we profit from nothing happening, right? From the price not coming down. So when we start with this, with selling the put, right? We are the sellers. We are getting paid. So the same way, any insurance policy, any insurance company, whether it's life insurance or whatever, car insurance, phone insurance, that monthly premium that you pay out every month, the seller of that insurance, right, does not want you to lose the phone. They don't want you to get into a car wreck. They don't want you to, they don't want the house to burn down, right? They just want to be able to just keep the monthly premium on a regular basis. Does that make sense? So when we sell put options, right? When we sell iron condors, or when we sell, we don't want the stock price to go up or down too high. We just want it to kind of stay in a range, and we profit from the stock price just staying in that range. And because we know options expire, we want that option to expire worthless, right? When my 6 months is up with Jake and I haven't crashed my car, he gets to keep all that premium, right? I don't get my money back just because I didn't get into a car crash. I bought insurance because I want to have that peace of mind that if I go out and drive and I wreck my car, that that Jake is going to do what? It's going to give me my money so I can replace my car. But Jake, on the other hand, being the person that sold me the insurance and got paid up front when he sold me that insurance policy, he wants the opposite, right? He does not want me to get into a car crash. So that's the premise of what an iron condor is. So selling iron condors, it's selling options that we believe are going to expire worthless, and we get paid up front, and we keep the capital if the market does not move too much. Okay, so if that's the one thing that I want you to understand, is that we sell options that we believe will expire worthless, and we get paid up front. And then we get to keep that capital if the market does not move too much. And we always sell puts that are below the stock price. So when we start with that, we start with that. Now, everything else that we do after we sell this put, when we add when we buy the put and then we sell the call and sell the and buy the call, is all part of the iron condor, but it's really now the hedging technique, so that we're not using up a lot of capital, because number one, if we just sell the naked put, we're obligated to buy something. We don't necessarily want to buy anything. We just want to be able to take advantage of time decay. Okay. And at the same time, we're selling a call up here because we don't believe that the stock price is going to go up too much, but we're going to hedge by buying a call option on that end here, and also on the put, buying a put option at the bottom here. So we're going to build this out in just a few minutes, and we're going to go up and take a look at a couple of them now. We don't just do this on any old stock. You want to do this on stocks that are going to give you that sideways to neutral pattern, right? So you wouldn't do this on a stock that's really volatile, that does a lot of movement, right? You want it on companies that are not moving up or down too much. Ahmad, yes, we let it expire worthless, but There is also the question of your return on time. So that's one of the exit strategies. Let me just put it that way. You can let it expire worthless, or you can exit the trade and buy it back so that you can take that capital and deploy it and use it for something else. And we'll talk about it with time decay and how the whole trade works. We'll look at an example here in just a second. Okay, but I want you guys to just get the premise of the ion condor is we're selling options that we believe are going to expire worthless. And the reason you would do an ion condor, it's passive income, right? You have your core delta trades. If you are a delta trader and you're buying you're doing your long calls, your long puts, all the different strategies that we talked about, that's what you're doing. If you have your theta plays that you do for trading, that's what you do. But the markets are not always going to give you bullish and bearish opportunities. There's also going to be times where the market's just neutral or stocks just remain neutral. So you also need to have something in your playbook to use when you have those conditions where the market is just sitting sideways. Does that make sense? So we use ion condors as a strategy for passive income, and it also depends on the type of trader that you are, right? If you are an active trader, meaning that you have time to be in the market, right? Day in, day out, have a daily routine where you go through and scan and look for new opportunities and get into trades and do all that stuff, then that's the type of trader you are. If you don't have that particular type of time where you can be in the markets every single day, then you're looking for more passive income type strategies or position trades where you don't necessarily have to be in front of the computer every single day, right? So ion condors, for me, and the reason I love them so much is because it's just that. The way we structure the ion condor, the way the system that we particularly use for the ion condor, it's a 60-day trade that plays out, and we add on another trade every 30 days. But it starts out as a 60-day trade, and then we add on every 30 days. That's particularly for the ion condor on the rut. Okay, so that's a system that we use every single month here at Tackle, and we deploy that system and that strategy every single month with that. Can you do this on individual stocks and individual companies? Absolutely, yes. You would have to make sure that you back test and first of all make sure that the stock is a neutral stock and doesn't move a lot, meaning it doesn't have a lot of volatility in movement, and then run the numbers and see if that works for you. So we'll take a look at both how it would look like in an individual stock, talk about the pros and the cons, and then also looking at it in indexes such as the Russell 2000. All right, so let's switch over to Thinkorswim here and start looking at a couple of these examples. And you guys tell me if you can see my screen here. Thank you so much. I appreciate that. All right, waiting for my screen. I'm looking at this on YouTube, but I've already changed my screen on on Zoom, and I'm waiting for it to flip over on YouTube so I can make sure you guys are following along. All right, there we go. All right, we're good, because I want to keep track of the chats as well. All right, so let's now talk about building the ion condor. Okay, now we've done this for so many years since I've probably been doing the ion condor consistently for about 4 years. It was introduced to me the first year I started trading, but I kind of was like in and out of it, really didn't understand the whole concept of it. And then it finally clicked with the type of trader and the way I was going about designing and building my own trading playbook. I have incorporated ion condors a lot more than I did when I first started. Okay, so here we are, we're looking at a chart of RUT. And if we just zoomed into 2019. So 2019, you can see the ion condor, the rut was pretty much on the sideways. They had that run up at the beginning of the year. well, we had that sell-off in 2018 in December, then we had that huge run up, and then it kind of stayed sideways and just didn't move much all year long. And then here we are in 2020, where it was starting to inch up, and then we had the huge sell-off, as did everything else. And now here we are with the rut, small cap companies now starting to catch up with the rest of the market. So if you're looking at the Russell 2000, it's been lagging the other indexes. If we look at the S&P, if we look at the diamonds, if we look at the Nasdaq, and if we look at S&P, the S&P already went past its highs from February, March, before the market dropped, right? And if we look at the diamonds, similar thing, right? Almost getting there back to the highs of where we were back in February. And if we look at Nasdaq, same thing, back and above where we were back in February from the drop in February. And if we are comparing apples to apples, I'm going to use the ETF for the Russell 2000, which is IWM, and you guys can see that it matches the Russell 2000, right? So it's same thing, hasn't gotten back up to where we were back in February, but it's finally starting to pick up some steam. It's starting to give us that movement that it's been missing, unlike the other stocks that have been going. So when we're looking for an iron condor strategy, you want something that is neutral to sideways. Okay. For example, if we were to look at a Goldman Sachs, because I did bring it up and Matt brought it up this morning when we were at the halftime report. So I want to trigger him for a second here when he watches the replay. This is Goldman Sachs. So when you're looking for when you're looking for an iron condor strategy, you want to trade stocks that are neutral. And with Goldman Sachs here, you can see that we have a resistance level here at we can call that 223, 224, 223 here. And we have a support level here of, let's call it 185. Can you guys see that? All right, so with that said, that's the kind of strategy that you're looking to do with an iron condor strategy. You want something that is sideways to neutral. When we're looking at building the iron condor, we're going to go to the trade tab. And the two main things that you want to look at with the iron condor is one or two things. Hold on one second, guys. I've got somebody at my door and I want to just, we're good. Hold on one second. I'll be right back, guys. All right, guys, I'm back. Nobody important, just the kids ordering dinner. Just dinner. It's just food. Now they're making me hungry, so I'm sitting here teaching and they're eating. All right, so where were we? So if we're looking at the iron condor, we can use it on individual stocks. We can use it on individual companies, but let's talk about what that would mean if you're doing it on individual companies. If you're doing it on individual companies and you're looking at a stock that's going sideways, you always have to factor in company news, meaning that random news can come out on any given day, right? It could be Apple announcing its new products, right? It could be anything happening with the CEO or anything happening with the company. And then obviously every quarter we have corporate earnings. So when you're doing individual stocks and you're doing iron condors, you have to factor in that it might be range bound, but at some point, if any news comes out, it might mess that up where it either goes any direction. Okay. The reason we do it on the index, such as the Russell 2000 or in ETFs or on SPX, it's because it's a basket of stocks, right? Therefore, you're not necessarily going to be affected by the news of one stock coming out from that basket, right? ETFs really don't have that much volatility, so there really isn't much premium in them. So that's why we particularly do it on the RUT. But you can do it on individual stocks. You would just need to obviously know that you're dealing with corporate earnings and you're dealing with company news of just randomness of the stock of anything just coming out in the news, right? But what you're looking for is something that's going to remain range bound for a while. Now, just to give you guys a little bit of a story of this, so why I got involved with the Iron Condor, I have to take you back and give you a little bit of a story. And that story involves Amazon. And because Matt brought it up this afternoon when we were at the halftime report, I did say that I was going to give you guys the backstory as to why I still like the Iron Condor. So I'm going to go back. We have to go back to 2015. So we're going to pull this back a little bit further. I've gone too far. All right, so here I am. I'm brand new to trading. I've never done anything before in terms of trading other than just being, the typical 9 to 5 or just putting money in a 401k and just kind of, letting it grow and go up over time, right? No cash flowing, no nothing. So I'm learning how to just, trade, right? Just order entry, position sizing, stop losses, this, that, and the other, all those little things that you guys learned when you're first brand new. And it was, primarily with stocks. I had not been introduced to the world of options yet. I'd heard of options that kind of like gotten the idea of, okay, it's a derivative of the stock and blah, blah, blah. You can use it as, in lieu of buying shares. You can buy something called a long call, but I really didn't understand the basics of it at all. However, I was intrigued by one particular strategy, and I guess it was just the name, right? And the Iron Condor, and when it was explained to me, it was like, well, it's one of those strategies where you don't necessarily have to pick a direction, right? If you're not good at picking directions, meaning if you have been delta trading and you keep missing your entries, or you're just not doing it right, or you just really haven't mastered that yet, Iron Condors does not require you to really have a direction. You just kind of need to be neutral in the market, right? And I was like, oh, that sounds good. Sign me up. How do I get this thing done? So for those of you guys who are Team Tackle, you guys know about our weekly reports that we put out on a weekend, right? Where there just happened to be one that particular weekend, whenever that day was. I believe it was like sometime in April, maybe in May of 2015. And there was, the options report, and it was an idea that came up during that for an Iron Condor. And the way it was explained, right, is that, the reason I picked Amazon. Now, if you look at this, you're going, well, you said it's something that's supposed to stay in a range, but this thing is gapping, like it's got gapping personality syndrome. Like, what the heck are you talking about? This is not an Iron Condor type of strategy, right? But if you look at what Amazon was doing, or its behavior at the time, right? The behavior of Amazon at the time is that it would report earnings. So if we go back to January, it would report earnings, it would gap, and then it would stay range bound until the next what? Until the next earnings date. And then it would gap. And then it would stay range bound. And then it would gap and stay range bound and gap and stay range. So when I saw I saw this, I said, okay, well, so as long as I avoid the corporate news events and get out of it before, then this could be something that I could trade, right? So that's what I looked at. And when that was introduced to me, I followed the instructions. I followed the rules of what an ion condor is supposed to be, 10 delta, 60 days out, whatever, all those things that we learn. And I put it on, and I promised you guys, I could not have explained what I did to anybody that came and asked me what I did. All I knew is that all Amazon has to do is just stay sideways, and I know I'm going to cash flow. That's about the only thing I knew about that particular trade, right? But now, obviously, over time, I've learned, right, about all the other things that come with it. But the key takeaway is that with an ion condor, you don't want a huge price movement, right? We cash flow from the stock price just kind of staying right in the middle, right? Not moving up too much, not moving down too much. And we sell out of the money options so that we can take advantage of the time decay, right? Now, when it comes to trading options, right, there's always the two things that we have to look at. We have to look at the delta, and we also have to look at the time, right? So when we sell options, you guys know about options, you want to sell 30 to 60 days of options so you can take advantage of that time decay, right? When we buy options, we buy longer time. When we sell options, we do the same thing, right? And because we're selling an ion condor, it's going to be the same concept. So we typically do anywhere between 30 to 60 days, okay? So it's the same concept. And you do it over and over and over again, as long as the stock is giving you that same pattern and that same trend. So that's kind of like what it was for Amazon at the time for me, right? I was just able to just, put the trade on, cash flow, wait for earnings to come out, whichever direction the earnings went, put it on again, and so on and so forth. So that's what got me attracted to the ion condor strategies, because it was a sideways to neutral type of strategy, right? And that we were able to profit from time decay, and that I did not have to pick a direction, right? That was the main thing. The main thing that just got in my ears. I make money from time passing, and I don't have to pick a direction. That's what an ion condor is. If you don't get anything else tonight, just get that, right? You make money from time passing, and you don't necessarily have to pick a direction, okay? So if we were to go out and build an ion condor, we're going to go to our options chain. When we go to our options chain, and I'm just going to use it on the Russell 2000. And as you guys can see, I already have trades on, and we have one expiring on Friday. So we have one more day in the trade, which is tomorrow. I currently have one on right now for November, and we're going to be putting another one on for December, and so on and so forth, right? So if we were to go back and let's look at, let's look at the trade tab here. If we were to just look at the ion condor strategy here that we have on the RUT right now, we have this one right here. And if I was to go to the Analyze tab and actually just highlight the one expiring tomorrow, because I have two of them on. Let's click on the one expiring tomorrow. So let's go. All right, so when we placed the trade, right, this was 60 days ago, almost now, we placed the trade. This is not where the stock price was. The stock price was a little bit further down. We can go back and look at the data and see when we put it on, but this is where the current price is. And if you look at this picture, and if you just understand the risk graph, okay, all you want is for the stock price to stay within the strike prices that we sell, okay? So for this particular ion condor, we sold the 1290 put, okay? That's the strike price we sold. We sold the 1290 strike right there. That's the 1290 that we sold, okay? And then we also sold the 1770 call. Okay, so those are the two options that we sold. And then what we did as a hedge, because we don't want to sell naked calls and naked puts, that would make it a strangle. We then went and bought $10 wide strikes, $10 wide strikes, and bought the 1280 put and then also bought the 1780 call. And I'm going to show you guys in just a second. But the whole idea is that if I put this in the chart, you guys will see that all we want to do is for the stock price to stay in the middle. It can go up, down, sideways, all at once, as long as it stays in that particular range. So let's go add slices to the chart. So now if you look at this, and we could probably go back and see when we put the trade on, because I want you guys to actually see. View trades. Trade we put on August 24th. So if I zoom in here, oops, zoomed in too far. If I go to August 24th, that would have been right there. Okay, so this is when we put the trade on. We put the trade on August 24th, and the price was sitting right around 1560. Okay, and what these lines here indicate is that this is where our profit zone is, right? So you sell far out enough that you still are able to get a little bit premium, meaning you're able to make some profit, get paid well enough for you to be able to actually sell the Iron Condor, right? So we got paid on both sides. And as long as the price stays in this range, we will profit. So remember what I told you guys before. We sell options that we believe are going to expire worthless. So when we sold the 17, and let's now go look at the trade tab. When we sold, not October. Oh yeah, it's October. So when we sold the 1770, at the time it had a delta of about 10. Okay, it had a 10 delta. Now it's got a delta of 0.04. So when we sold it, when we sold the 10 delta, and I'm going to start seeing how you guys, my options traders, what the probability was. When we sold the 10 delta, what was our probability of that strike price being in the money? It was a 10% probability, which means we had a 90% probability of it not being in the money. That we had, the probability was that it was going to remain out of the money, right, and not be in the money, and we would get to keep that profit. On the put side, same concept. We sold the 1280, got paid to sell that. It was probably also a 10 delta. We usually go 10 delta or less, so that's where we usually start to look at where we're going to put our trade on. And we also got paid on that side as well. So when we sell these, we're looking for a specific dollar amount, right? There has to be enough meat in the bone, but then you also have to have enough cushion. If you guys have probably heard Tim talk about, cushion and cash flow, right? You want to be able to get enough cash flow, but also give yourself enough cushion to allow the stock price to move, but still have the options expire worthless, right? So we sold the 1290 and got paid on this end, and also sold the call on the call side and did this. Now, when you put these two together on the call side, really what we're doing is a bear call spread, right? And what we're doing on the put side is a bull put spread, because we're selling a call and buying a put. I'm sorry, we're selling a put and buying a put at the same time on the put side. And then we're also selling a call and buying a call, which makes it a bear call spread. So if you already do bear calls for cash flow, if you already do bull puts for cash flow, when you put the two together, gives you the Iron Condor. But when we build it out, we build them out all together and we get paid on both sides, okay? So if we go back to the Analyze tab here, this is where we are now 60 days later or 59 days later. So when we sold the Iron Condor, we instantly got paid $110. That's the premium we received for selling the put option. I mean the Iron Condor. And then over time, right, the value of those options has been decaying. Okay, to the point where now at expiration, tomorrow is going to be expiration day, or Friday morning will be expiration day, right? I am going to get to keep the whole value because we're at expiration. Now, could I have bought back this iron condor at some point, maybe bought it back for 5 cents or 10 cents and whatnot? Yes, I could have done that, right? But because of where the stock price was, I really didn't feel the need to do that. Now, as the Russell 2000 starts to continue to go up, and we had a little bit of a pullback today, but it broke that major resistance level here at 1600. So had it continued to inch up over the next few days, could I have done something and exit the trade and kept a little bit of the premium and left some on the table? Absolutely. That's where trade management comes in, but we're not going to get into that today. We're just talking about the basic concept of what an iron condor is. Okay. Yes, you can also leg into as well. Absolutely. So this is what it looked like for this month that's expiring tomorrow, on tomorrow. So now if we go and look at our following one, which is now the November, that's also in play, we can now go analyze that. And I'm going to uncheck these other ones because I don't want to mix both of them in there. Now, if we think about the whole idea of that, we want the stock price to stay in the middle, and we want it to stay in a range and not go up too high or too low. Now, if I was to draw the same picture now and put these slices to break even and then set them to the chart, now here we are. So for November, what we have in play, if we go look at the strike prices, we have the 1250, 1240, and we have the 1780, 1790. So now kind of like in the same price range as the other one was, but a little bit lower on the put side. Okay. Now, if we look at this and go look at the risk graph, which side feels like it's being a little bit more threatened? If this was the middle of the iron condor, and this is where the price was when we first started, the Russell 2000 has been going up over the last few weeks, right? So we have our bear call side and we have our bull put side, right? So our bear call side isn't making any money right now because the stock price is going up. The bull put side, however, is making money. So if I was to uncheck them and look at them separately and say, okay, let's just look at the bear call side. The bear call side is what's losing us money because it's threatening the what side? It's threatening the upside. Remember, the idea is that we profit from the stock price staying in the range and not getting above this strike, getting this price, the call side, correct? So if you look at the distance, just visually looking at it, right? If this is the current price of the stock at 1621, right? Are we closer to 1780 or are we closer to 1250? Which side are we closest to? Are we closer to the upside or are we closer to the downside? We're closer to the upside, to the bullish side, right? So when it comes to trade management, you're going to be keeping an eye on the call side, on the bear call side, because you don't want it to come and go past that price that we sold, that 1780 price. Does that make sense, guys? So real quickly, we're going to Yep, absolutely. So real quickly, we're going to look at how we would put this together for the following month. And remember, we said we do these right around 60 to 30 days, right? And because this is a passive trade, it's a passive investment, right? I don't need to worry about managing it on a day-to-day basis. I'm going to put the trade on, figure out what my stop losses will be and all that stuff, and then just let it do its thing, right? And that's why I like it so much, is because it takes away that emotion of me having to manage and babysit this trade every single day. Does that make sense, guys? So real quick before we run out of time, because I know we are going to be heading up against the clock here real quick. And I do have another class I'm teaching. We're teaching the 8:30 class. We're going to continue with iron condos. This is just to introduce you with the concept and what the strategy is. And then we'll talk about systems at the 8:30 class, like what kind of systems we trade, whether it's the iron condo, the cash for condors, how sometimes I use them for earnings plays when I don't necessarily want to do short strangles and so on and so forth. So we'll get into that at the 8:30 class, but this is just more or less to just kind of introduce you to the idea and the concept of what the iron condor is, right? Okay, so real quick, if we were looking at this, so I'm going to give you guys the rules, right? So like I said before, we always want to start with a 10 delta. That's where we start the premise with. You can do 10 delta or below. Again, it's because you want to give yourself enough space. You want to give yourself enough room for the stock price to still go up and down, but not touch the strike prices that you sell. If you think of it like like a baby in a crib, like you want if the baby is sleeping, you want the baby in the crib sleeping, and if the baby starts to get up and start to jump over the crib, then we're in trouble, right? If you think of a bird in the cage, right? You want the bird in the cage. You can fly all you want, but don't try to get out of the cage, right? Stay in your range, stay in your lane. Don't try nothing, it won't be nothing, right? When it does break out, that's when we just start dealing with all kinds of stuff, right? And the birds get killed, and it's it's downhill from there. But just understand the concept of the iron condor is that you just want the price to stay in the middle. All right. So real quickly here, we're going to start with the 10 delta, and then we're going to look at the visual and then figure out whether we need to adjust it, move it up, move it down, but we're going to start with the 10. Okay, so now when you're doing an iron condor, you don't need to worry about having anything else on your options column other than the delta. Now, there are many ways that you can do this. You can do it individually, or you can change it into a vertical if you want to, but I'm old school. I like to click it one by one. So I'm going to start with the 10 delta, and then we're going to go and check it out. So if I look at the delta column here and just go straight down and find the 10 delta, that's going to be my 1330. Okay. Now, if you're going to build this individually one by one, leg by leg, you have to hold down the control button. Okay. So when I press on the control button, I'm going to hit sell, and it's going to bring the first order. So there we go. We've started with so by itself, this is just selling the put. Okay. We're doing a $10 wide. So I'm just going to go and sell $10 wide. So if I sold the 1330, I'm then going to buy the 1312. So again, I'm going to hold down the control button, and now I'm going to click buy. Okay. Typically, we're looking for about 50 cents credit. So this is more than enough. So now I know I have some wiggle room. I can even go lower if I want to give myself more room. This is where now cash flow versus cushion comes to play, right? And we're going to look at the visual and see where it lines up. If we don't like where it's at in terms of the risk graph, now we know we have what? We have 35 cents to wiggle with. We have wiggle room. We can move further down if we wanted to. And I'm going to go now on the call side and do the same exact thing. I'm going to find a 10 delta. So now here we are. This is your 10 delta here. So we're at 1835. Once again, I'm just going to press the control button, and I'm going to click sell. Okay. If we sold the 1835, that means if it's $10 wide, we have to buy the 1845. So I'm going to click buy. Okay. Now all together combined, I'm getting $1.75. So if we're looking for 50 cents on the put side and 50 cents on the call side, we have a combined 70 cents to play around with, right? 75 cents to play around with. If we're looking for just the base minimum payout of $1, if you're getting 50 cents on this side and 50 cents on this side. So now if I go and analyze this, I'm just going to right click and analyze. I want to look at the picture now. And let me uncheck all the other ones that we have in play. Okay, so this is our December. This is where the current price is, right? It's sitting at 1620. We sold the 1835 and bought the 1845. And then we also sold the 1330 and bought the 1320. Now, let's talk about risk and profit. So your potential profit, if you were to keep this the way it is, if you were happy with this and where the current price is and where the strike prices are, if you are happy with this, then you would just send your order in. But you need to understand what your reward is and what you're risking. And this is where trade management comes in. If you do nothing in terms of managing your trade, okay, and you let the stock price either go up and pass your strike price that you sold, or if you allow it to come down and pass the strike price that you sold on the put side, your maximum risk in this trade that you put on is going to be $825. Okay, because that's the buying power. That's what the broker requires in order for you to put on this trade. Okay, so your position size rules or how you will put this trade on will be based on what your risk tolerance is, right? It's not about how much you want to make, it's how much are you willing to risk per trade. So that's what determines how many of them you do. Now, one of the ways that you would exit this trade is just to exit if it touched the short strike price on the put side, or if it touched the short strike price on the call side. If that's the rule that you use to exit, then you're looking at about a $300 loss if it goes on either direction, 333 on the call side and about 265 on the put side, if the price was to come from where it's at to this price point right here. So you would exit the trade and that would be your loss. So if you're comfortable with that loss, let's say, for example, you have $1,000 risk tolerance and you would do 3 of these because your risk tolerance is $1,000, right? But you need to understand that if you do nothing at all to manage this trade, your maximum risk, this is where max loss comes into place, right? Your max loss would be the money that you actually had to put in to get into the trade, which is $825. Now, the reason that it's $825, remember we sold a $10 wide spread, right? So that's $10 per contract, right? So one contract has 100 shares, so that's $1,000. But we also received $1.75 per, so that's 175. So because we got paid, remember we're the insurance company, we got paid to sell this premium, to sell this insurance policy. We got paid $175. So that means the broker is not going to, if they paid us $175, they're not going to charge $1,000. They're going to take out $825 as your buying power. So that's the money that they're going to hold for the trade. So if you do nothing in terms of managing this trade while it's in play, then that's going to be your max loss if you do nothing to exit and manage the trade. Okay, not 300 a day for the duration of the trade. For the duration of the trade, because remember, this is a 60-day trade and we make money from time passing by, right? So every day time passes by, as long as the stock price is between these ranges right here, we get to keep that we get to keep that profit that we received, right? Remember the statement I made you guys say earlier, right? We sell options that we believe will expire worthless, and we get paid up front and keep the capital if the market does not move too much, right? So you only get to keep that $1.75 if it stays within this range. If it does not, and it starts to break either below or above it, that's where you start to experience your losses. And the reason why we sell 30 to 60 days is because we want to take advantage of that time decay, because time decay the options do decay faster when it gets closer to expiration. So that's why we do 60 to 30 days, right? Remember, when you're buying, you buy more time. When you're selling, you sell less time. So it's the same concept. Gotcha. How did I set the break even to the chart? Okay, watch this real quick, and then I'm gonna let you guys go, and I'm gonna do some Q&A if you guys have any questions real quick. All right, so right there, this little column thing right here, I don't know what to call this, but this little thing right here, if you click on set slices, okay, It brings up another column where you can say set slices to break even. And I want it to be set to break even, not on today's date, because this is when I'm putting on the trade, but I want it to be set to the date it actually expires. So I'm setting them to when this option expires, which is December 18th. So when I do that, it moves those prices there. And then once I do that, I then go back and now I say set the slices to the chart. So once again, set slices to break even. And then you do it to the expiration date. And then once the prices are set to the expiration date, then you want to go to set slices to chart. When you click that box, it then takes you to the chart and voila. So when you get the visual from the Analyze tab and then the visual on the chart, if this range, you're comfortable with this range, then this is where you would put your trade on. If you want to give yourself more room to the upside, we have cushion. Give yourself some more cushion. If you want to give yourself some room to the downside, remember we had 85 cents to the downside. We can still mess around and give up 35 cents of premium to give ourselves more cushion if that's what you want. So always remember, we start with the 10 delta and then work our way down. Look at the visual, take a look at the strike prices on the chart, take a look at the risk graph and see where the price is today versus where it will be at expiration. Play around with it a little bit more until you get to a place where you're comfortable. But we're always looking for a minimum 50 cents on the call side, 50 cents on the put side. We're getting $1.75, so we still have 75 cents of premium that we can still mess around with if you're going for that minimum $1 total profit. Make sense, guys? So that is your Iron Condor strategy. And again, the reason I love it so much is because of being able to cash flow with time passing by. And I don't necessarily have to sit there and pick a direction, right? I have my core strategies that I do when I want to do directional trades, but I also need to have those, keep me calm and keep me in my Zen type strategies in my portfolio so that I don't lose my mind. And Iron Condors do that for me in my portfolio. So that's why I love them so much. And we are 10 minutes beyond our time. So if you have any questions, I am not going to cover adjustments today. I just wanted to introduce you to the concept of the Iron Condor. We do have a monthly webinar where we talk about this strategy every single month, Robster. So I don't know if you are a Team Tackle member or not, but you are more than welcome to come out and give us a try. If you just go to Tackle Trading, actually there is a link on the YouTube channel right above it there. I believe you can get that link there as well. If not, I will find it for you and I will put it here in the chat for you. Give us a try. This is what we do every single month in terms of Iron Condors. We have a specific strategy that we do it on. We do it on the Russell 2000. So go ahead and give us a try. If you have not, if you're just now finding us, go ahead and give us a try. Let me send you the link to that as well. And yeah, but I just wanted to introduce you to the concept of it. All right, let's see here. Where is my link? Here we go. All right, any other questions? Cool. All right, I'm grabbing the link for you here, Robster, and you are good to go. Let's see if it pastes here. Copy, paste. Here we go. So go ahead and give us a try and let us know what you think if you are new to Tackle. Let me get my YouTube here posted, and I'm using two monitors, so I have to log on to one to get the other one going. Here we go. All right, here's your link. All right, guys. Well, thank you so much for joining me tonight. If you are Team Tackle Pro member, hop on over to the Mastermind 8:30. I'll see you guys in a few minutes. Did you guys have fun? Did you learn something new? Did it go over your head? Awesome. Well, thanks for joining me guys tonight. Really appreciate you guys. Have a wonderful day, and we'll see you guys soon.